Do you contribute to a qualified retirement fund? Well, in that case, you should watch this video, Managing Retirement Fund Transactions. If you have any questions about this topic, you can leave them in the comments section below and I'll do my best to help you. And of course, if you feel the video helped you, I hope you will click like and don't forget to subscribe to get updates on new videos that come out all the time. Retirement fund transactions are very different from any other type of transaction that you have previously experienced. They're not the same as recording transactions in a bank account or credit card account. And you may well ask, how are they different? Well, normal bank accounts, you deposit the income that you earn and that will increase the balance. And with normal bank accounts, when you pay your normal expenses, the balance decreases. However, with a retirement account, you will deduct as an expense anything that you deposit into the account. So that is the opposite of a normal bank account. And for a retirement account, you will include in income anything that you take out of the account, and that will decrease the balance. So because of this opposite behavior, we need special procedures. And I have created a procedure, you could call it the Mark-Smolin method or Mark-Smolin strategy of recording retirement transactions or retirement fund related transactions. Each retirement fund transaction should be recorded 2 times. Once for the effect on the income statement and again to adjust the effect of the balance sheet. Now this is because tax rules run differently from normal generally accepted accounting principles. And generally accepted accounting principles are what QuickBooks was designed to be used for. That's why we need this special method. This method is easy and smooth and will make everything correct. So, what happens on your profit and loss when you record contributing to a retirement fund? Well, the cash in the normal bank account will decrease because you took money from your normal bank account and you put it into a retirement account. And then you actually have more deductible expenses to reduce your net income on your profit and loss because you took money from your bank account and you put it into the retirement fund. However, for that very same transaction, you also have a balance sheet effect. You now have an asset called retirement account balance, and that number goes up. The balance of that asset, retirement account, goes up at the moment that you take money from your normal bank account and put it into that bank account. And as a result of having more money in a retirement fund, you also have more net worth. Now, I will be happy to do a special video in the future explaining why net worth will increase in the second entry for the very same retirement transaction, but net worth is the account to choose. Now, what happens when you withdraw from a retirement fund? Well, the effect on your profit and loss is as follows. The cash in the normal bank account will increase because you took money from the retirement fund and you put it into your normal bank account. But you also have an increase in your taxable income because any withdrawal you made into a retirement fund that you had previously deducted will count as income at the moment you withdraw the money. So once you withdraw money from a retirement fund, Your cash in bank goes up because you put the money in your normal bank account, and your taxable income also goes up. But at the moment you withdraw from a retirement fund, something else is happening. For that same transaction, the balance of the retirement account goes down because you just took money out of the retirement fund. And your net worth goes down as well because you have less of that asset. And again, I will be making a special video explaining why net worth is the other account that changes when you have a retirement transaction. So let's add the retirement accounts we need to QuickBooks. First, we need a bank type of account which represents the balance of the I.R.A. Let's go ahead and add that now. From the main menu, click List Chart of Accounts. Then in the bottom left, click Account, New. This is a bank type of account. Click Continue, and we will name it I.R.A. Balance. Save and close. Click No for the advertisement, and now we have an account that represents the asset balance. What else will we need? Well, we'll need an expense to record when we take money from our normal bank account and put it into the I.R.A. So we click Account, New, and this is an expense type of account, and the name of it will be I.R.A. Contributions. And I like to put the word expense there, save and close. And we also need an income type of account to represent the money that we take out of the I.R.A., which will be part of our taxable income. Account, New, and this is an income account, and the name of it will be I.R.A. Withdrawals, and we click Save and Close. Now we have the accounts we need to record retirement fund transactions. For example, let's imagine on November 16th, we took $3,000 from our normal Chase checking account and deposited it into a qualified retirement program's bank account. And in this example, that bank account is an I.R.A. So this transaction is so nice, we record it twice. First for the effect on the profit and loss, and we use the write checks window. Then again for the effect on the balance sheet, and we use the journal entry window. Now, at the moment we record this, the bank account will go down because you have a deductible expense, I.R.A. contribution expense. And that's what will happen at the moment we record this check or this transfer. So we also know we will use the write checks window in order to do this. You click Banking, write a check, and the date is November 15th, of 2016. Okay, and we are contributing $3,000. Now watch carefully. The money is coming from the normal bank account to this deductible expense, I.R.A. contribution expense. And don't forget that this is deductible and includable in your taxes, so you have to choose class in this case. Now when we click Save and Close, we can open the trial balance, and you can see you now have the deductible expense, the $3,000 IRA contribution, and you also have decreased your bank account by $3,000. Look, double click, scroll to the bottom, or scroll to November 15th. That $3,000 lowered the balance of the bank account. But we are not finished. We now have to record that same transaction again for its effect on the balance sheet. The retirement account balance goes up for the money that you just put in the account, and the net worth also goes up. So watch how we record that. We record that in the journal entry window, and we use the same date as the check because it's really part of the same transaction. So from the main menu, we click Company, Make General Journal Entry, and the date is the same as the prior transaction, and you must remove this check mark because this is not an adjustment. This is an actual transaction, and the account that's increasing as an asset is the I.R.A. balance, and you make a debit for $3,000. And the balancing credit for $3,000 is your original net worth, because your net worth is not changing because of your normal net income. So the balancing account in this case is original net worth. If you want, you can make a separate equity type of account just to track the net worth associated with your retirement funds, but you don't have to. Save and close, save anyway, and now you can see you have the IRA balance, which will go on your balance sheet as an asset, and you can see original net worth has increased to $15,500. Now, to complete our little story, let's do an example where you actually took money from the IRA. Let's imagine on December 20, Joe withdrew $500 from the IRA for pocket spending cash. What will happen regarding the profit and loss? Well, the cash on hand will increase because you now have more spending cash because you just took that money from your IRA account. But on the other hand, you now have more taxable income. And the reason why you have more taxable income is because if you previously deducted from your taxes what you put into the IRA, then when you take out money that you already deducted, that becomes income that you have to include. So we will record this first for the December 20 transaction, and we will use the Make Deposits window. Watch. Banking, Make Deposit. Now, the account that you're actually depositing the money into is your cash on hand. Remember, your cash on hand counts as a separate account if you're going to track it using the QuickBooks software. So you have more cash on hand in your wallet as of December 20 as a result of taking it out of the IRA. But the account that you choose is the income account. The income account IRA withdrawals. So your cash on hand is going up because you have more of this type of income, IRA withdrawals, 500. And because it's income going on the profit and loss, you have to choose non-exempt deductible class to make sure that this gets included in your income to calculate your estimated taxable income. And this is the way you record the first of the two entries. When you click Save and Close, you can see your trial balance reflects more cash on hand, and as a result, you have this $500 as income IRA withdrawals. However, you are not finished. You have to do the balance sheet side of this transaction. The retirement account balance goes down and your net worth decreases accordingly. And I will make a future video explaining why original net worth is the account to use to balance the entry. And again, we use the journal entry window and we put the same date as the deposit we just recorded because it's really the second half of this transaction. From the main menu, we click Company, Make General Journal Entry. The date is the same as the deposit. The account that's changing is the I.R.A. balance, but now it is decreasing. And if this account is normally a debit balance and it is decreasing, that means we have to put the decrease on the credit side. And then the balancing 500 goes to original net worth, which is an equity account. Click Save and Close, and we don't need a class because they are both balance sheet accounts. Save anyway, and now you can see the I.R.A. balance is correct for what's really in the account, and your original net worth has been adjusted accordingly.